Hello, everybody. Good morning, good afternoon, good evening. I think we've got a lot of time zones tuned in for this one. Mark, I'm surprised that we're not seeing you in your PJs at this hour, but I really appreciate you joining. Everybody, you have the luxury of sitting with Mark Velik, who's an investment principal at EVP. He's based out of Sydney, Australia. EVP are one of the premier VCs in Australia, and we've worked with a number of their portfolio. We see a lot of things in common with all of their portfolio companies, which is that they're real businesses, which I'm really excited to learn more about today. Mark, I know you sit on the board of a number of different SaaS companies, ex-McKinsey, and of course, a good guy. So I really appreciate you spending the time with us today. What did I miss? How's that summary? Is that okay on your side?
Great summary, and thank you, Dave. Great to be on the call today, and great to be chatting to all the good folks dialing in. No, I think you nailed it. We're a decent-sized venture fund out of Australia. We've got a portfolio of 44 software businesses that we work with, and have been the privilege to be on the board of all those businesses, ranging from the very early stages when you're just getting started with a handful of customers, all the way up to folks that have scaled well through the 100 million ARR mark. So hopefully a few lessons from that journey perhaps to share here. But yeah, looking forward to diving into it.
Awesome. So I've got a question for you, I guess, just to kick things off. Is what does startups look like in Australia? Is there a difference between the makeup of an Aussie startup versus maybe those based in different countries, like the US or Israel?
Yeah, really, really great question. I think the one that is the most obvious one, typically compared to US ones in particular, is just really strong capital efficiency. And it is largely out of necessity. The venture industry in Australia is pretty new. It wasn't around for a long time, and it's pretty small as compared to other geographies, be it the US or Europe or Israel or wherever it may be. And just as a result of that lack of capital, companies have been forced just to be really capital efficient. And with that, I suppose, have a really strong focus on a lot of the topics we're talking about today of, really focusing on sustainable growth and the like. So it's probably the main one. And equally, I suppose, the one that, folks chat about is by virtue of different time zones, there's been a requirement to, have scalable sales channels that haven't necessarily relied on having the person, in front of the buyer. And, how do you go about doing that product-led sales motion, or just, the self-sign-up ability to, sell to customers. So the likes of Atlassian and Canva have kind of really led the way on that. There's nice success stories out of this side of the world.
So I'm assuming, given that a year like this, where maybe capital isn't as freely available, people are quite conservative, it favors a company that's maybe more used to that, right? Would that be fair to say?
Yeah, absolutely. I mean, we will, again, get into it in the presentation, but I think with markets really rewarding profitable growth, if not profitable companies, at least making sure there's the underpinnings of a profitable business in there. It's never been more important than today. And certainly the Australian businesses typically thrive in that environment where, again, they just haven't had the cash to be able to afford to have a non-profitable go-to-market motion. So yeah, definitely seeing a lot of that and a lot of companies being rewarded for that fact.
So, I mean, I'm sure a lot of early stage founders are looking, now and maybe scratching their heads or trying to get in front of VCs. What's your take in terms of, what a VC looks for in a startup?
Yep, good question. And I think, a lot of this stuff hasn't necessarily changed a massive amount over the, macro changes we've all seen over the last, 12 months or so. But, big part of it, as you can see there, standout founders, a lot of the folks I'm sure dialing into this have kind of, come from a deep background in whatever industry or problem they're solving. And that's critically important as a VC when you're kind of assessing an opportunity. I think there's a reality that, as much as we may claim to be thesis driven and the like, really we're relying on founders to understand their industries incredibly well and come with that product insight. So that's a big part of it. Clearly having just a compelling product and service that frankly people are willing to pay for and hopefully pay more and more for over time is a big part of it. And critically important for folks in my position is that there's a lot of potential buyers for that product or service. There's a reality of, funds having certain returns that they promise to their investors, and we need to see a business be able to get to a certain size. So, the market size thing is critical. That number 3 you can see on the screen there, sustainable business models. That's kind of probably the one that's come more into fashion these days, or we've always seen it as important, but there were probably a couple of years there where people forgot about it and didn't care about it. But making sure there is, a real business to be built here, even if you're, you might be pre-revenue or pre-profit, whatever it may be, at least ensuring that there's a way to make money out of this business over the long term and there's a path to profitability is super important. And then number 4, there's the one that, everyone's more typically aware of, but still matters a lot, is just that opportunity for really rapid growth and kind of the opportunity to build a big business in relatively short time. There's plenty of examples of multi-billion-dollar enterprises that took 40 years to get there. In the venture world, I suppose you're looking for ones that can get there much more quickly than that, hopefully over a kind of 5 to 10 year type horizon.
I think it's really interesting that you said, path to profitability, because a lot of founders that I speak with are feeling almost like this year that they have to grow fast and be profitable. And so how much of an appetite, or maybe this is, a company specific, but how much of an appetite does a VC have, or how much patience does a VC have today to see that path? Is it something that a founder is presenting on screen and saying, hey, here's what we'll do year 1, year 2, year 3, year 4, year 5? Or is this something that you check every quarter?
It's a good question. I think there's different levels of profitability and different tolerances of it. So clearly there's is the business profitable today and generating cash? And folks would love to see that. There's the version of it that says, I'm not quite profitable at that net profit line, but there's a profitable go-to-market motion and we're choosing to burn cash purely on the development side of the business. And I think, and then probably the third version of that is, we're not profitable at the bottom line, we don't have a profitable acquisition engine, and we're losing money. I think that in terms of tolerance, that third bucket of we're losing money on acquisition and we're losing money at the bottom line, the tolerance for that has reduced dramatically. I think, 2020, 2021, a lot of money swashing around. People were totally focused on growth and didn't, they kind of said, okay, put it in a PowerPoint presentation and one day you're going to get profitable. I think the tolerance for that has completely evaporated, at least in our part of the world. And I'm sensing kind of overseas as well. There's a pretty well-known example of that, an Australian business, which unfortunately announced yesterday that they were going under, a business called Milk Run, where it was kind of one of the instant delivery of your groceries startups. They raised kind of $84 million and unfortunately have gone under now. And that's the perfect example. They kind of had a huge compelling opportunity, amazing founding team, and a really great service. But the unit economics or the profitability on each customer today wasn't quite working. A couple of years ago, the whole venture industry was willing to fund that. Today, folks aren't willing to fund that anymore. And as much as they had a clear pathway to achieving, positive gross margins on each customer over the next few years, unfortunately, it wasn't there today. And unfortunately, the market didn't end up choosing to continue to back them. So that's probably the big shift we've seen.
Do you think that affects deep tech companies as well? Or can they maybe write off the fact that they're saying, well, look, we're building, I don't know, a new form of rocket ship. Maybe that's not a good example, right? We're building some sort of brand new technology the world's never seen. And that's going to take a long time. So please keep paying us to build it. Is that hurting them too?
Yeah, it's a good question. I'm not from that world, so take everything I say with a healthy dose of skepticism. But I think in that world, what's probably changed is there are a bunch of tourist investors when money was free that were probably playing in that world who have probably retreated now and focusing what they know well. For those sorts of enterprises of deep tech, med tech, and the like, where there's necessarily a longer time frame to develop your products and get product into market and the like, I think there are the right funders for those businesses who will continue to understand that model correctly. And it's different to the talk track I just gave, which was much more software centered. But there's a lot of money that was available to those folks, which just won't be anymore as folks have retreated back to the investing that they understand well.
Now, you spoke about the tenacity to build a large business. And this slide or this stat that I'm about to present kind of blew my mind when I saw it. I mean, I always, intuitively knew it was tough, but I had no idea that the odds were against you so soon in the journey. So just for everybody on screen, we've got fewer than 10% of startups that raise a seed round successfully raise a Series A investment. What's your take on that, Mark?
Yeah, it's surprising. You always see the one of what percentage of startups raise any money or survive or don't die. But it's I agree with you. It was surprising to see that one in terms of a pretty low percentage of folks that go on to raise that second or third round of capital. Yeah, I think it's real. Again, I think it probably points to the fact of the last however many years there was really a huge amount of capital available at that early stage before folks had real customers, had real models. And that's probably evaporating now. And at the end of the day, folks investing more at our stage do care about seeing real traction, real customers, and the real opportunity for profits way down the line. And it probably, it does speak to that tenacity point. There's just, a lot of execution risk as you go on that. And in plainer words, it's really bloody hard to get those early customers to really generate revenue in the early days, to convince investors that, all the good points around we have a product that people will buy and here's the 100 customers that I can prove it to you. It's really hard. And that's why, be it a founder that can do those sales themselves, can attract the talent that can then do the selling themselves, convince folks that this business is real. It's really hard. And I suppose why that founder profile matters so much in the investment decision for an early stage investor.
Yeah, I think that's exactly it. That last point is something that we see as well. I mean, just anecdotally, and we support a bunch of seed stage and Series A and beyond companies. The seed stage ones are under a lot of pressure to figure out who their ideal customer profile is, and scalably grow and at least show, let's say, a path to profitability. And I think that your point is so right in the sense that is much easier when you can stack the deck in your favor. So if you're a founder who came from a specific industry, has a lot of contacts, and can already start, maybe you've already built your product with those people as, your first beta customers, paying customers, it sets you apart from someone who had an idea. Maybe a few years ago, it was easier to just, hey, I was walking on the beach and I had this idea to build these new beach toys and I'm going to go get funding to do it. That might have been okay then, and now it's much harder, right? Not a good SaaS example, but I guess
I think that's totally right. Like the reality, I can give the venture version of needing to look a founder in the eye and say this person's going to take my money and make something off it when there's not a lot of runs on the board. How much more important is that for your early customers who are buying, if we're talking software and B2B software, they're buying a product to run their entire business off, when you've got no logos on your website, no proof points that this thing actually works. At the end of the day, you're looking a founder in the eye and saying, are you going to screw my business or not? In my livelihood. And there's just, I suppose that's why that founder role is so important, that, you're looking the owner of the other business to say, hey, I'm real, I'm not going anywhere, and we're going to be around for a long time.
Yeah, 100%. You've got here that as of 2023, sustainable burn matters as much as headline growth. What do both of those terms mean?
Yeah, sure. So this one's based on, if you look at listed markets now, a bunch of folks have done some really great analysis as to what's actually the most determining factor for valuations for software companies in listed markets. And, for the folks on the call, I'd highly recommend Meritech, a fund out of the US, which is a great fund. They've developed an online tool where you can kind of play around with this analysis, kind of looking for this at all the software companies in the US listed world at least. But there's a bit of analysis that you can do with that tool that basically shows what the greatest determining factors are for those valuation multiples. And, over the course of, 2020 and 2021, and probably for a long time before that, growth was the only thing that mattered. And if you're growing really well, your company was valued very highly. It didn't matter how much you were burning. And that's fantastic. I think the thing that really shifted with the recent kind of, falls in share market, rising interest rate environment, et cetera, is that a greater determining factor than your historical growth is now a thing called a rule of 40. And I won't go into what that metric means. It's a little bit complicated, but it basically compares, it's a combination of growth with how much money you're losing as a business or cash that you're generating as a business. And if you look at the explanatory power now, it's about that influences the stock price, or at least the valuation, twice as much as your historical growth rate does in today's market. So it's just this massive shift in terms of what investors are willing to reward companies for in paying high valuations for. And that's certainly flowing into venture markets in the early stage, at least what we're seeing now. So as much as, folks only cared about growth a couple of years back, today it matters. You're growing, you're not burning too much cash today, and there's a strong underlying acquisition engine there that's actually, scalable, efficient, and has the underpinnings of profitability.
So less important what you've done and more important what you're doing. Right? The historical growth matters less. So if you've got something running and maybe you were a business that was kind of on the previous schedule, you've already got to kind of maybe switch up and look at your costs, your efficiency, where you're seeing growth. Do you have to show a shorter path to profitability than maybe you did?
Yeah, it's a good question. I think, trying to make it real for early stage folks that are seed stage, Series A, I think there's an understanding that you're going to be burning cash, and that's why you're raising venture capital. And there's, the person sitting across the table is the investor that's looking to invest. They're giving you money because they also see the opportunity to burn money to generate shareholder value. So I think there's a tolerance for that. But I think the notion that you can be going into the millions of ARR or above $1 million ARR while you've got an acquisition engine that costs more to acquire a customer than that customer's worth to you over the next 2 or 3 years, the tolerance for that is really diminishing. And that's, I suppose, the thing that I would encourage founders on this call to think about is, even at the early stage where you've got a pretty early team and you're figuring out who your customers are, to at least be watching those sorts of figures incredibly closely and understand, what does it cost to acquire that customer? What exactly are my unit economics in terms of what a customer's worth to me? How quickly do I pay back that acquisition spend once the customers are paying us cash? I think hopefully you're there throughout the journey in terms of having that profitable acquisition model. Again, you can keep earning on dev costs and rent and whatever else it may be. But at least, hopefully you're there, but at a minimum to be having a really close look at it and being able to tell a story around it to potential investors.
Now, I don't work directly in SaaS anymore. I work now for different SaaS companies to help them grow. It's a little bit different, a bit more of the picks and shovels business than the gold rush, perhaps. But when I was in SaaS, the focus on the CAC to LTV ratio is always 3-to-1. Is that the same now, or do you have to do something different with those numbers?
That's a good question. I think that still is the reasonable rule of thumb, and there's good reason for it. I think the challenge with that measure, which a lot of investors are kind of coming onto now, is the fact that it's really hard to figure out how long a customer is realistically going to stick around, particularly at the early stage where you've only been selling for a year or two. Who knows if your customer is going to stick around for 3 years or 5 years or whatever it may be. So that ratio is inherently a little bit tricky. It's not quite the same measure, but the associated one that's closely linked is one that we prefer to look at, and a lot of investors I think equally like to look at, is just payback period. So it's kind of for your ticket price and how much it costs you to acquire that customer, how quickly are you paying off that acquisition spend? It doesn't quite capture the inherent profitability in that you might take you 3 years to pay back the acquisition thing, and if they stick for 10 years, that's great. That I think based on your price point and your sales motion, you can have a pretty good gut feeling as to whether where that payback period should sit.
What's an acceptable payback period today, or is that like a how long is a piece of string question?
No, it's a good question. I think the rule of thumb we use internally, if you're selling and the largely self-sign up, maybe demo-led acquisition model where your customers are paying you anywhere between $70 and $400 a month for your product, If you can keep your payback period below 12 months, that's really, really great. And there's, inherently really profitable business there. Anywhere from probably 12 to 18 or getting close to 24 is probably tolerable without being amazing. Beyond 24, you're going to have a really tough time of it just because it is such an expensive acquisition thing. If you think about how long, you're sinking whatever it might be, $1,000 a customer to find a customer and, do that. It just takes a really long time to pay that off. That's quite specific for that price point though. If you're in enterprise world, if you can have it under 12 months, amazing, but it's pretty tricky. And with the long sales cycles and the cost of your sales folks, in that world, I think anything, less than 24 months, you're doing pretty well. Beyond that, it's getting tricky, and you probably don't want anything close to 3 years and beyond.
Makes sense. Okay, let's talk about as they grow up. So we've got here that once a startup reaches a Series B or Series C round, it will probably work for 1.5 to 2 years before bringing in new capital. Why is that?
That's a good question. I think, there's a little bit of a philosophical one of why you're raising capital. I think in truth, venture capital, for the folks on this call, should be a last resort. It's really expensive money. Like, you only raise venture capital because you can't raise debt it's difficult to raise debt as an early stage company that's burning cash and doesn't have a whole bunch of customers. You raise venture capital because there's no other funding source, and you're so incredibly motivated to, you see the opportunity to give away part of your business to grow really quickly and enhance the overall pie of shareholder value. So I think, if that's the framing here, that, 1.5 to 2 years before bringing in capital is, typically the time period where, you've raised a bit of money, you want to put that money to work, invest behind it, hire some salespeople to invest in your product, whatever it may be. There's just time that it takes for the returns on that investment to generate. And that window of 18 months to 2 years just seems to be the tolerable one from external investors, the amount of time to really see good uplift on valuation that everyone wants to see and the like. But typically just seems to be that sort of window. I think what that 1.5 to 2 years looks like is something for folks to be really, really careful about. There's the version of that where you're just burning the same amount every single month and diving into the ground, which we wouldn't recommend. There's a version of that where you say, hey, I'm going to make my bets early, increase burn at the start, and then kind of come in and keep reducing burn as you're growing your revenue line with a soft landing that you have optionality at the end of that, 18 months to 2 years. Whether you have to raise capital or can do something else, that's, I suppose, more what we would recommend and what we see the better founders doing.
Is it a tougher year for a Series B or Series C company trying to raise capital at that stage than maybe an earlier stage company?
Yeah, absolutely. I mean, the reality, I think, is the closer you are to the listed space in terms of stage of company, the more that your funding reality mirrors that of the listed markets. And I think, clearly valuations have come off in a very significant way on that end of things. I think, particularly in the US, you've got a whole bunch of the growth stage investors who are maybe banking on their companies being able to list, and really healthy valuations have just been hurt by those sorts of things. Or I guess by what's happening in the listed markets, and they just bring a different psychological mindset to when they're assessing earlier stage stuff now. There's, I think as well, when you're getting to that Series B or Series C stage, you're of the scale that a non-profitable acquisition engine and huge burn at the bottom line is just less tolerable, and there's no real good reason for it. You should have the scale to be able to operate a bit more efficiently.
So you've got to grow up pretty quick. That's what I'm hearing.
Yeah,
pretty much. Okay, gotcha. Let's talk about how founders should think about 2023 and beyond. What's your take?
Yeah, I think, the first couple we probably touched on already, that in terms of being deliberate on cash burn versus just, you're saying, I've raised $5 million, I've got 2 years to spend it, I'm going to therefore, whatever that works out to be, spend 200, we'll burn 200K per month, then we're just going like that into the ground. Not a good idea. If you're able to make your bets early, give those investments time to have impact, and then kind of come in for a softer landing, I think really, really important in today's environment where, first off, folks are rewarding lower burn, and second off, where it's just a harder, more difficult raise environment, that approach to being deliberate on cash burn just matters that much more. In terms of that, repeatable, scalable, profitable go-to-market channels, again, there's just less tolerance, I suppose, for go-to-market motions that aren't like that. And, hopefully you can get there today, but if not, having a clear story on how you're going to have a go-to-market motion with whatever those 3-to-1 LTV to CACs and, shortish payback periods is really important. In terms of 3 and 4 there, focusing your raise efforts on like the investors, I think that's probably what we were touching on with the deep tech investors. In an environment where it's more difficult to raise capital, there's less capital that you're probably sitting on as a business. I think not wasting a 6-month raise period, speaking to every investor in the world, a bunch of whom won't be relevant for your company, is not what we would recommend, and a really difficult trap. The worst thing for a business is to have a founder completely distracted with a raise process that takes them out of the business, away from selling and away from cost management, if that's what's required. So, highly recommend in today's environment being, do your research on your prospective investors, figure out which ones are right for your stage, for your type of business, for your geography, for your industry, et cetera, et cetera. I think it's just that much more important. And then, that final one, increase focus on what is working. We're totally aware as a founder, all sorts of weird and wacky opportunities come up for your business. And it's very, very tempting to, go down that rabbit hole or chase that shiny thing. Again, where capital is more expensive and less abundant, just really encourage founders to try and reduce those distractions, focus on, what the actual core business is, and make sure you've got great growth, great unit economics, and a clear plan on the cash side of things. Is really, I think, the right way to go. But you just don't have the, I suppose, margin for error that you maybe did a couple of years ago to, waste 2 or 3 months going down this rabbit hole or chasing this or taking your eye off the ball. It's just not an option anymore.
It's so funny that point number 4, I can count on one hand the amount of times that I've come across founders that actually execute like that. And I think it is because they make big promises at the beginning that, everyone is going to want this, and therefore we have huge appeal across the world. And so having appeal in one category or one geolocation is sometimes, maybe it's self-perception, maybe it's a past perception. It's seen as almost like a weakness. And I just remember very clearly speaking with a German founder who was building a really successful SaaS company just in Germany. And I remember speaking to him, and one of my first questions when I'm doing discovery for us is, well, are you looking for international expansion? And he was like, no, not for at least 2 years. We're still really growing nice and strong here in Germany. And the only other time I've come across that is with Aussie companies. Now, in Israel, it's maybe different because the local market is relatively small. The population is increasing now, so that's changing things. But still, they kind of are born ready to expand globally. But just the amount of times where we've seen it on the sales development side where we go, hey, remember we tried these 3 different options and we're trying them all at the same time. This one's ready taking. Let's kill the other 2 and double down here. The amount of resistance that we usually see at that point is insane. And I would say 90% of the companies that we work with at those stages or that we've worked with in the past really struggle here. The other thing is, just coming to your first point on the cash burn, right? You can kind of, idle down, right, to a crash, or burn really quickly at the beginning and then reduce the cost as necessary. Those 2 kind of tie in. And this is also something that I haven't had as many, let's say, I haven't seen as many conflicts of opinion here, but I still see this challenge come up all the time where you say, look, hey, okay, we've started something. We dipped our toe in the water, right? And it's warm. Let's jump in now. We don't have a lot of time. Your whole thesis to your investors is, I'm going to grow exponentially. I'm not going to grow, and I see it often that founders will hold back and say, well, let's dip the second toe in. Let's dip the third toe in, slowly, even when they see really great signs that they figured it out. And I just think that those are really, really solid points that you've raised there.
It can be scary. I mean, on that cash point, to take a bunch of money and then in the first 3 months after investment to just scale your burn really quickly. It is bloody scary. I get why it's tricky for founders to kind of stomach that, but I suppose just giving yourself the time to see whether those investments are going to work, and then having the time to course correct if you need to is just so massively important.
Yeah, totally. So I want to get your take on this. I was just thinking about some, just basic practical steps that startups can take to secure customers, because ultimately, investors are already important, but customers maybe are more important or are already, necessary to get that investment. So I think the first thing, and maybe, I think people think that this is only a tool that they need at the very beginning. But the first step is really networks. A lot of founders think that leveraging their networks is something that I had to do before I raised money. But once we've raised money, I'm not going to do it. And I remember, we were working with a Series A company. It raised a lot of money. I think it was close to $20 million. And the founder had the most incredible network. And one of the first questions that we had when we started working with them was, are we going to leverage this? Can we build a program where you reach out to all of these fantastic companies that you're connected with and just set up the first conversation? And they were like shocked, right? Like, I'm a founder now, I'm not doing sales development. I'm not doing business development. Are you seeing, I know you kind of answered this already in the sense that you said, look, founders have got to have that strong network, but are you also seeing that companies that have maybe still matured, are they still kind of going back and reworking and are you seeing founders more on the ground in terms of trying to generate sales than maybe you were a year or two ago?
Yeah, 100%. I think it's honestly one of the biggest mistakes we see from startups that have raised capital is taking the founder out of the sales, the sales conversation. I think there's a surprising reality of how far your founder-led sales should take you as a business. Like realistically, we've had companies that have gotten to like 5 million ARR where the founder sold every single contract. This is relevant more for the enterprise world than I suppose the demo-led world. But in that enterprise world, there's just a reality that the founder is going to be the best salesperson for the business for the life of the business, right? They're the only ones that can look someone in the eye and say, I'm going to be here forever and this is real and I'm doing it. They understand the industry the best. They understand the problem the best because they built the bloody thing in the first place. Is just a reality of that. And where you take a founder out of the sales process too early, it has pretty dramatic ramifications, and you're letting more junior salespeople potentially or more senior ones that don't get the product out into the wild with less efficiency. So yeah, huge issue, and definitely there's a greater appreciation now of founders needing to stick around in that front sales process for longer. Particularly in the world of longer sales cycles. We had an interesting bit of feedback as well. One of our companies, a business called Moven, which sells software to the construction industry, the founder made a really interesting point that, all the reasons I just touched on, getting a founder involved in the sales process to close the deal was really important. But equally, the founder can be really valuable as a frontline qualification tool for prospects that are coming through the door. They just have a much better sense of whether someone is being real and is the correct buyer, and if this if this solution is really solving for their need. So actually, counterintuitively, they actually get the founder there to be quite involved in the early days. But I suppose overall, just again, tighter capital markets, lower cash sloshing around, making as best use of the founder in that sales process, just massively important at the moment.
Yeah, I mean, I posted about this a few weeks ago. As a CEO, you kind of have an all access pass, and I'm specifically thinking enterprise sales, right? And even for ourselves, I mean, we built a sales team and launched them at the end of last year. And basically, speaking from personal experience, what I've done is I'm only closing deals that come from my network and from my own cold outreach. Everything that's coming warm through our website is going through to the sales team. And, someone asked me, so like, when are we getting you off, the sales? Someone internally asked me that question. And I was like, never. You're never getting me off the sales. I still need a sales team, but I'm always selling, right? And maybe at some point, if we decide to go down the route of investment, we're not a SaaS company, but that's selling too, right? And I think that it's such a strong point that those sales skills are critical. And one, you got to work your network. I think the second point is on referrals. Referrals are probably the best way to drive business. We built our company on referrals. Many companies, find their next best customer through that. And I think, they're so important because similar to what you referred to when you said, look, I'm still going to be around, people want to know that what you're offering actually works and is good. So they're going to want to talk to a non-biased, customer that's actually received, those services or using the solution and know that it works. I think that's just another area that in the past maybe was like a nice to have. Like, oh yeah, we've got, there's not many companies that are sitting with an active referrals pipeline where they're plotting out, who exactly do we want referrals to, from which customers, what are we incentivizing to do it, who's taking over this program, and how are we measuring it. I think net new is so attractive that you just don't think about like taking your current group of customers and leveraging that, right? And I would say, and just to loop in, I'll add number 5. I'll just skip around because we can, Mark. We can make up our own rules here, but partnerships kind of aligns in that, right? Like, if you've got industry partners, maybe they are operators in the industry, maybe they're connected, to key players, and getting them to make introductions is another area that is so undercooked. It's usually only left till, all right, like we've kind of exhausted everything else, so that's all going on. Now we need a partnerships team, and we have to be a much more mature business to do it. Whereas almost from the get-go, you could do this. At the very least, just get referrals from referral partners that are trusted and credible to point people your way.
100%. If I could just on 1 and 2, a nice example from our portfolio business called Smarterbase, which was recently acquired by another business called Teamworks, but they sell a software solution to professional sports teams. And the founder there, Marcus, he just had some success over here in Australia, and then he went over to Europe and tried to crack that market. And what he found, which he wasn't expecting, and which I think most folks wouldn't expect, is willingness of his early customers in Europe to sell to their own competitors and to make introductions to their competitors to also use the software, which is one we actually see time again in the portfolio now. So in his world, it was a bloke from Welsh Rugby who was a buyer of his solution, and he opened up his Rolodex and said, I'm going to introduce you to every single head of rugby across all the different countries and rugby clubs and whatever it may be. And I think there's, a psychological piece there of folks want to be known as the innovator in their industry, and they want, their peers who, they get to catch up with in the pub or at the conference or whatever to know that they were the first one to buy this sort of a solution. So, one that, a really interesting tactical one, I suppose, for folks to maybe take away is don't be afraid to ask your customers for introductions to other folks in their industry. I'm sure they're often more willing to do that than you may perceive.
I think even doubling down on that point, I mean, we forget that it's all individuals, right, that you're working with. There's key people in each company that you're working with, and building those deep relationships is critical. That person might move, right, to another company and bring you back in. And especially if you're selling like marketing tech, that's your play, right? Every 18 months or so, a CMO is replaced, and they're going to buy stuff that they bought before. Same with the CISO. And so those deep relationships is super critical. But I would also argue that, especially in a year where many people are quite concerned about making sure they're getting enough money in their pocket, there's also an angle, and you can do this all above board, in working with people as a side hustle and compensating them for every referral. You don't always have to. There's plenty of people actually that would work against. So if you said to a person, look, I'll actually pay you, let's say you're Welsh Rugby guy, if your founder might have said to him, actually, I'll pay you for everyone, he might have been completely put off by it, like, because he's doing it out of, he's just passionate about what you're producing. But there's nothing wrong with that. And I think that there's something there that people just aren't tapping into enough. And also understanding enough is how much you can leverage those personal relationships of people that you trust, that trust you, to expand it. Branding is another key one. I know that usually when people are being fiscally conservative, they think of branding as kind of, fluff on the side. It's not as important. We want to just focus, like, show me the ROI on this activity, and branding takes a long time to see ROI. But I'm going to argue that when people are looking for a solution, if they have a problem maybe, and they're looking for solutions, if you're not able to be in that one sentence answer when somebody says, well, who's good? Who should I use? If you're not in that one sentence answer, you're really going to struggle. And that's the goal that I've kind of always set internally for our marketing team, is like, I want to be in that one sentence, right? When somebody says, hey, we're looking to, I don't know, expand overseas or what have you, right? And break into a new region.
I think on the branding one, it's totally aligned. It's often in enterprise software, people think, I don't need to spend on marketing. It's all hand-to-hand sales combat. I think the misnomer on that front is it doesn't need to be massive billboards and huge marketing spend. I think having a really deep understanding of where your prospective buyers hang out, where they live and where they congregate is really important. And then figuring out how do you get brand front and center for those folks. You can actually do it in a pretty cost-effective way. And just make sure that, I suppose it's, to your point, just understanding the emotional drivers individually for those sorts of buyers, who they are as individuals, and what's, for your referrers, for your buyers, for whoever it may be, understanding what's going to make them tick and recommend your product.
Yeah, I think this is something that, again, I've spoken to a number of people about this year. When you think of like creating an ads budget, okay, and you're thinking, well, we're going to use, I don't know, LinkedIn or Google ads, we're going to segment by these types and what have you. That will work, sure. But is that the most cost-efficient way? Or are there, and there's all sorts of interest groups, Slack communities, Discord groups, etc., where you actually have an audience of a whole bunch of people that care about the same stuff. And if you can build trust and leverage that, that might be a better place to focus your efforts. If the end goal is, I'm trying to sign on and bring on more revenue in the shortest possible period. And so it comes kind of almost to your previous point, which is, again, linking into number 4. If you can focus on key things that are working, if you can focus on key verticals or locations or customer types that are working really well, I don't think too many people are going to question it, as long as you can either, one, I think, show that, hey, the revenue's there, and it's a pretty deep market, and maybe 2, we're still cooking a B test somewhere else, right? The A test is going great. We're doubling down here, but we on the B side, we're still trying a few little things to see what else is going to work.
I think, on that point, I'd go even further and to say, as an investor, it's really scary when you're looking at a company that hasn't figured out who those key buyers are and hasn't nailed a specific vertical. If you've got a horizontal play that can potentially work for a whole bunch of industries, the scariest thing is not knowing which ones it's really resonating with. You'd much, much rather see that, hey, I've got whatever learning management software that works really well in the construction industry and in the, architecture industry, whatever it may be. And at least identifying, okay, there's a really good channel I can go down. I know exactly how to buy the customers in that channel. That's much more comforting for an investor because it's knowable, it's investable behind, there's a plan to go after it, versus if you haven't figured that out, it's often a little bit scary because you don't really know how to build an engine to go after the world. It's very difficult.
Yeah, and I think even more on that, like if I look at companies that have built software for a specific vertical, and it's almost, there is a ubiquitous version out there, but everyone in this vertical uses whatever, this specific CRM, can also price very differently. I think there's 2 things they can do. One is they can price very differently. Usually they can add like a higher margin, they can price more. If you think of like med tech, ed tech, those are 2 like examples. The other is that I think it's easy to get in the door. Just being on the front lines in sales for a long time, when you're talking to a prospect and you're saying, yeah, I know that, whatever, let's use CRM as an example. I know there's all these CRMs, but we're the only one that is purpose built for your industry. and we really understand these needs. And as such, we've got widget A, B, C, and D that solves these problems that as a educator or a real estate agent or whatever your vertical you're appealing to, that you guys understand. I think that really gets you in the door. And if founders understood that, I think you kind of have to wear two masks. On the one side, when you talk to investors, you have to show that I have a huge market that I can appeal to, and this is just one of them. But we're going here now because of where we're getting results. But on the customer side, I think each time you go after a vertical, ideally they should feel like you were purpose built for them and you totally understand where they're at. And the only way you can do that is by spending years building up an understanding of each one and just going piece by piece by piece by piece. It obviously depends on what you're doing, but if you have that capacity, it probably helps.
Yeah, couldn't agree more.
All right, we've touched on the other two because we skipped around because we broke some rules. But now let's talk a little bit about what we've seen in the past, what we're seeing now. And I might slide between them each. So let's go number one. So firstly, excitement about innovation. What I'm kind of referring to there is you used to be able to get in the door based on being something new. That alone would be enough to spark somebody's interest. Now, if I jump over, it's more about a focus on cost or time savings. So buyers are less concerned with like, hey, we've built this new, generative AI that does A, B, C, and D, than they are about, well, we've found a way to help you solve this problem that you've had more effectively or quicker or cheaper, or make you money, right? Or what have you. That's more interesting. And we see that just in the leading conversations that we create. And we live in that MQL to SQL world. That's all we're doing is talking to people that I've either never heard of your product before, or maybe they've signed up to a free trial, and kind of showing them enough of the value in that short kind of conversation or back and forth of email or LinkedIn, whatever, to get them into a serious conversation with the sales team. I was just wondering what's your take on that? Have you seen
totally agree. I think there's, again, really understanding your buyer. Again, probably more focused on the enterprise software side of the world here. There's a reality of the motivating factor for that buyer inside the large corporate has changed dramatically in a world where, capital markets, the interest rates are close to zero, capital's freely available, folks are trying to grow. Yeah, they're getting patted on the head for finding the innovative new solution that when, their CEO wants to get in front of the shareholders and say, this is what we're doing with generative AI, it's like, oh, look at this new solution we bought over here to help with our business. That motivating factor has completely changed now. Now it's that person's worried about losing their job. They're running through cost-cutting processes internally in their business, and they need to show, for me to warrant paying for this piece of software, it's either going to reduce cost elsewhere, or it's going to drive revenue somewhere. And just the motivating factor, I suppose, has shifted the pendulum back to, the old days of no one ever got fired for buying IBM. Right. There's kind of the old moniker. No one, for someone to take a punt on an early stage business is just much inherently more risky for them in their day-to-day job. And they really got to have a better understanding of the ROI on that investment.
Yeah. I think the other area that we've seen across the board, and again, I'm generalizing, PLG companies maybe have shorter sales cycles here, but we used to see sales cycles anywhere from 3 to 6 months. Again, price can, change things. If you're charging 6-7 figures, then that's a different conversation usually. Now we've seen that increase more in the 6 to 12 month stage. So people are still coming to the first meetings. Buyers are still coming to the first meetings, but getting that decision to actually part with their hard-earned cash for a license is taking much more time and consideration.
Yeah, totally aligned with what we're seeing in the portfolio and, all the research reports coming out in the listed space. It's exactly what you're saying from CIOs. They're delaying buying decisions in greater uncertainty to have a better sense of what they're buying and the implication on their business. Definitely the case. I think the one where that comes into focus is to the extent you have short-term requirements for cash, for growth and the like, just being really targeted in an understanding of which part of your pipe is going to close more quickly. Are there certain verticals that you have, you resonate better with? Existing customers, deals with those folks are probably going to convert more quickly. So I suppose in that environment with the longer sales cycles just being hyper targeted, where you're focusing your sales effort matters obviously that much more, where to invest 12 months into a sales effort that's not going to, might not generate a customer at the end of it is just a much more painful reality.
Yeah, totally. This next one's a bit SDR specific or top of funnel specific, but we've worked with dozens of B2B SaaS companies, and there's really three main go-to-market channels or tools that you can use. It's the phone, there's email, and there's LinkedIn. That's pretty much it, right? Let's maybe group LinkedIn as communities. Okay, I won't say specifically LinkedIn. Today, across the board, we're seeing LinkedIn and email outperform the phone. And I think that the reasoning for that, at least, my 2 cents of it, is that because buying anything takes more consideration, platforms that are either built on relationships like LinkedIn or these kind of interest group communities where you have to build a level of trust before someone's going to buy from you, and platforms that are built on education like email, where people want to be sent materials to review, are going to be more likely to receive a positive response to a selling conversation than a phone call, especially if let's say it's outbound, where there's only so much information that you can transmit on the phone before someone wants to review it, discuss it with somebody else who's heard of you, who you're working with, etc. And that's my take. I don't know. I mean, maybe as a VC, you don't see this or you don't really focus on this at all. But again, though, maybe it ties into what you're seeing. But I was just wondering if you have a take on any of that. Have you seen anything like that from your portfolio companies, or do you ever get into it with them and say, "Hey, what channels are we using here?"
In truth, it's probably a little in the weeds for us. I think the one takeaway and what we're trying to focus the conversation on again is get deliberate with this. So rather than just kind of ignoring what's working well, is to kind of at least run the analysis of where are we having cut through, where do we want to double down our efforts, rather than just pushing a whole bunch of money at a whole bunch of channels and letting someone else think about it. I suppose it would be the critical takeaway we're suggesting our founders to focus on.
The last one that I want to just talk about is I don't remember seeing as many C-levels involved in purchase decisions a few years ago as I do now. And I was just wondering, is that something that you're seeing too, just in terms of the amount of consideration that every, let's say software spend is going through now?
Yeah, no, 100%. I think, certainly more when you're selling to an SMB customer, the proprietor of the business cares a lot more about that now. It comes from, your point one of, folks focused on cost and time savings and people being worried about their jobs and worried about their business spending money. That all comes from the CEO. So the real reality of that is the CEO, there's spend freezes in place. There's all sorts of hiring freezes in place. The idea of investing new money on an unproven solution in market, again, without all the trust signals that everyone's used about, the CEO is much, much more likely in today's environment to want to get involved in that buying decision and verify for themselves that this thing is real and going to drive value for the business.
I also think just, as that is the case, the way you sell has to change. Because, as a CEO, you care way less about many features and way more about, does this save us money? Does this buy us time? Does this make us money? Etc. Right? Just to dumb it down. And I see that also, like when I get pitched by vendors today, if they're starting and they want to walk me through and suddenly the screen share opens up and they're walking me through the product and this is where this button is and click here to do this, I might need like a minute of that just to get a good sense. But usually someone in my team's already done that and said, hey, I've looked at all of them. This is the best one that I've seen. It's within our budget. Now go chat, right? And so 100%. I would just appreciate a conversation that starts with, all right, here's what I understand about your business today. here's how our solution is going to attack this problem that you're having. This is how you should measure the value of our solution. And this is why it's worth investing X amount in it. Those kinds of upfront conversations, and those can be a 15-minute, they probably should be, to be honest. Like, as someone who's changed from being a salesperson to now maybe a buyer, more than seller, I would prefer that, right? If someone came ready, prepared, and ready. And I think that I said this before we started, but like the premise of my whole take on this space this year is, until now, you could probably get away with order taking and build a business off order taking, meaning that the buyer came knowing exactly what they wanted, and you just, were the do you want fries with that type of approach to selling. Today, you have to really sell, because you have to convince people that what you're providing is really valuable to them, that you care about them, that you're going to be here in the long run, as you said, that you're going to provide a greater benefit to them than where they could have spent that money elsewhere, or something else that they could have spent that money on. And it's really hard. Okay, there's a lot of pressure. And by the way, I would even say selling is not just to customers, but to investors too. You're going to have to probably show investors a path to profitability, as you said, Mark, and really strong growth rates. And you can whitewash a lot less, okay, than you probably could in 2020 or 2021. So I just think it's interesting.
Yeah, the other comment I'd probably make just on this point of C-levels getting involved is, it's true. I think to your point, both in sales conversations and with investors, where there are longer sales cycles, often halfway through the sales cycle, the economic buyer or the decision maker in a venture fund has actually changed pretty dramatically. And I think re-verifying exactly who's making the decision, what the right pain points to touch on, is just incredibly important. Too often, probably more on the capital raise side than the sales side, but in both worlds, we've seen folks thinking, hey, I got my champion over the line, this thing's about to sail through. And then all of a sudden, there's 5 new decision makers who care a lot more about this decision than they did 3 months ago when you first started the sales cycle. And the whole thing comes, and you've made business decisions on the fact that sales closing or that funding's closing, and it's just a new environment on that front. So I think just reconsidering as you go through the process is just critical in today's environment.
Mark, it's been an absolute pleasure. It always is. So I really appreciate you spending this time with us. If people have got questions, if they're looking for funding, if they want to pick your brain, where's the best place they can get a hold of you?
It's a good question. Best to reach me on email. I'm at mark@evp.com.au. I should, qualify. We invest in Australia and New Zealand-based founders only, unfortunately. So if you're looking for investment, I'd keep that in mind so as not to waste folks' time. But always happy to have a chat, share any tips and tricks and that sort of thing. Feel free to reach out.
Awesome. Thanks so much, Mark. Have a good evening. We'll speak to you again soon.
Thank you very much.